Hello, everybody, and welcome to our quarterly AFC Fund webinar. My name is Thomas Hugger, and I'm the CEO and founder of Asia Frontier Capital. With me today are Ruchir Desai in Hong Kong, who is managing with me the AFC Asia Frontier Fund. Ahmed Tabaqchali, the chief strategist of the AFC Iraq Fund, is today in Baghdad, Iraq. Scott Osheroff, the chief investment officer of the AFC Uzbekistan Fund, is in Tashkent, Uzbekistan. And Vicente Nguyen, the Chief Investment Officer of the AFC Vietnam Fund, joins us tonight from Ho Chi Minh City. This webinar will last about 45 minutes, and thereafter you will have the opportunity to ask questions during our 15 minutes Q&A session after the presentations. You can submit your questions online through the Q&A icon at the bottom of the Zoom window on your laptop, PC, or mobile phone. Our AFC Asia Frontier Fund, and especially the AFC Iraq Fund, started very well into 2024. The AFC Asia Frontier Fund was up 4.7% as of end of March 2024, and the AFC Iraq Fund was up 4.5% this year. And April is another good month for both funds so far, especially the AFC Iraq Fund, which is this month currently up 2 digits. However, it is really difficult for me to understand why emerging markets, frontier markets, and value stocks are still shunned by global investors. But on the other hand, stock markets in the developed world are trading at or close to their all-time highs. For example, our AFC Asia Frontier Fund still trades at a PE of only 7.1 times, which is very close to its all-time low a few months ago. But I'm convinced this will change soon. Ruchir, over to you for the outlook of the Asian frontier markets on AFC Asia Fund, please.
Thank you, Thomas, and welcome everyone to another quarterly webinar from AFC. So I'll start off and talk about the AFC Asia Frontier Fund, what's driven performance this year, a few slides on macro, and also on the outlook for some of our country picks and top picks going forward. As the slide shows, basically, as Thomas mentioned, and in his opening comments, Asian frontier markets had a pretty strong start to the year. In fact, a very strong start to the year. As this chart shows you, many of our markets are in fact among the top 10 performing markets globally this year in dollar terms. Kazakhstan, Sri Lanka, Iraq, and Pakistan all in the top 10 performing markets for the year, and pretty strong returns so far in the first probably almost 4 months for the year now. And this again shows it's basically a continuation from last year. It's not just this year, which has been strong for the fund or for Asian frontier markets. Even last year, our markets were very strong. Last year, the fund was up 27%. As of now, as of today, the fund is up about 3% for the month and about 8% for the year. So pretty strong start across the board. And again, like I was saying, continuation from last year, but also continuation of outperformance against other emerging markets in the region. So if you look at the chart, most of the emerging markets in the region haven't really performed over the past 18 or 24 months, and while Asian frontier markets are now performing very strongly. So this is, again, a continuation of the trend. And this does not surprise us at all. I mean, for example, if you've been on our webinars for the past few quarters and read our monthly newsletters, I've been basically writing since the beginning of 2023 that our markets are very well set for re-rating. And that's kind of played out very nicely with the performance over the past probably 18 odd months. So again, a couple of factors, lower interest rates, recovery in macro and earnings, and also discount valuations, which I'll talk about later on. And that's the reason why I'm not surprised by this strong performance over the last few months, or last few quarters. So that's the opening slide. And just on the next slide, as the next slide shows you, is sticking to performance. For example, it's performance, as the chart on the top left shows you, performance for the past 1 year for the fund has been almost 30%. And again, like I mentioned, outperforming the region and also outperforming all major indexes, especially, for example, other emerging indexes like the MSCI ASEAN Index or the MSCI Emerging Market Index over the past year. But also over the past 3 years, performance has been pretty strong. For example, the Asia Frontier Fund is up about 14% in the last 3 years. While if you look at as the chart on the top right shows you, pretty strong performance. But if you look at, for example, other developing countries or developing indexes, especially, for example, MSCI ASEAN Index is down about 5% over the last 3 years. It's not really performed. Same for the Emerging Market Index, and also for, I would say, most of the frontier markets. I mean, so for example, the point I'm trying to make is that a lot of people talk about being bullish on many Southeast Asian economies in the region. Yes, some of them, of course, Vietnam is a very good story. Indonesia, possibly a good story, but I'm not sure about the other, stories out there in Southeast Asia. because they've not delivered returns as the chart shows you. So I'm not sure about many of the Southeast Asian economies in terms of giving long-term performance. And as performance has shown from the fund and also Asian money markets, they've delivered returns over the past few years, especially over the past 2 or 3 years. So they're delivering returns, they're delivering economic growth, they're delivering reforms. So and valuations are attractive. So that's my point. I think Asian funding markets are a much better bet over the next 3 to 5 years compared to some of the Southeast Asian economies. They're going from a low base. There's reform. There's some of the stories like Vietnam and Sri Lanka or Kazakhstan and Georgia stand out. So I think these markets are worth looking at and being invested in over the next 3 to 5 years compared to some other markets in Asia. And fund performance has been very strong across the board. It's not just one or two countries or just a few stocks which is driving returns. It's basically across the board. For example, returns for the past 12 months have been led by Iraq, Kazakhstan, Vietnam, Pakistan, Sri Lanka, Mongolia, Georgia, and Cambodia. It's a very broad base. So, like I said, we're outperforming the region. So that's a bit on performance. And as the next slide shows you, just a bit on macro or global macro. Yeah, this is a slide on basically the US Fed fund futures. Of course, there's been a lot of noise, a lot of talk about how much the Fed is going to cut, when they cut, won't they cut. And the last couple of weeks, the expectations for how many interest rate cuts will happen this year has kind of decreased as this chart shows you. The line has gone, the maroon line has gone higher because the market now expects the Fed to kind of cut interest rates further down the line and not so soon. But in any case, I mean, I'm not a US economic expert, but from what I see, I don't think you should miss the forest for the trees. I think at some point the cycle is turning. I don't know whether it's going to be one cut this year, two cuts, or seven cuts, or five cuts, or it's going to be June or December or sometime in 25. But basically, the key headwinds of the US Fed, the aggressive Fed or hawkish Fed which we had in 2022 and first half of 2023 has played out. That's exactly what my point has been for the last probably 12 months, and that's led to a re-rating in many of our markets. Not just because of low pressure from the US Fed, but also many markets, many central banks in our universe are already cutting interest rates. So even if, for example, US inflation is at 3.6 or 3.7% and the Fed doesn't cut this year or cuts only once, I'm not really so concerned about that because inflation in many of our markets has already significantly come down, and there are many other drivers for the central bank monetary policies in our markets besides just what the US Fed does, like inflation and other factors in those countries which have turned the corner. And that's why I'm so positive on our markets. So, for example, as I mentioned, Asian frontier central banks have already cut interest rates. As the next slide shows you, inflation, as the chart on the top left shows you, inflation has come off significantly across our markets. So, like I said, I'm not so concerned whether inflation for 1 or 2 months or 3 months is higher than what market expects in the US. But in our markets, it's coming off significantly because many factors which drove it, like supply chain issues, macroeconomic issues, or high commodity prices, that's kind of is favoring our markets now in a positive way. So, for example, Georgia or in Sri Lanka, inflation is now basically less than 1%. And we've seen a pretty strong drop in inflation in Kazakhstan as well. And as I mentioned, that's led to interest rate cuts pretty aggressively in our markets because many central banks raised interest rates extremely aggressively in our markets in 2022 because of multiple factors. But for example, now since probably June 2023, we've seen interest rate cuts across the board in many economies. For example, Sri Lanka has cut interest rates by 700 basis points. Georgia by close to 300, and even in the countries like Mongolia are now cutting interest rates by 100 basis points just last month. So I think all the factors which are important for our economies are moving in the positive direction, and not so much linked to what the US Fed does or what happens to the US dollar compared to what the situation was maybe 18 months ago. And I think the next central bank to cut interest rates will be in Pakistan. I think most likely second half, but possibly 50-50 chance they cut even next Monday as inflation possibly has come down even more in Pakistan. So important factor to keep in mind over here that, the macro has turned the corner in our markets in a positive way. And as the next slide shows you, in terms of country specific, after spoken about, Bangladesh and Vietnam benefiting a lot from supply chain shift in our markets. So that's very positive for the long-term development. I've spoken about Central Asia being a good story, with Georgia, Kazakhstan, Uzbekistan. But I think country which is kind of being ignored right now and which probably would possibly get more attention going forward, has got its attention in the past probably 12 months and probably will get more attention going forward, is Sri Lanka. So stock market is up more than 20% in dollar terms. The Sri Lankan rupee has appreciated 8% this year. I keep seeing on Bloomberg that many Asian currencies are appreciating now because of a stronger dollar. For example, Indonesia, Philippines, Malaysia, India, etc. But Sri Lankan rupees appreciated because the macro is turning in their favor now. They're coming out of a crisis. They're not going into a crisis. So, for example, as the chart on the top left shows you, tourism revenues, tourism arrivals are basically on a on a roll now. So, for example, for the past 4 months, tourist arrivals have been more than 200,000 tourists, which is the peak season now, and they've gone back to almost 90% of pre-pandemic arrivals, and they should be back to they. I think they should overtake pre-pandemic numbers by end of 2024 because the arrival numbers are strong. There's strong bookings from many of the hotels or listed companies in the leisure industry that we speak to. So very strong recovery there. And also as the chart on the top right shows you remittances, worker remittances, for example, from the Middle East, from the US, from Europe, from Australia, etc., have come back pretty strongly. And they're almost back to pre-pandemic levels. About they'll do about $7 billion this year. So you get $7 billion from remittances, about $3.5 billion from tourism this year. So you're doing about $10 to $11 billion just from these two sources. So that's very comfortable for your balance of payments, for your current account, and for repayments of external debt, which begins probably next year. So Sri Lanka is in a pretty good position in terms of macro stability, and that's why I think you'll see more attention being given to the country. Plus, you have, like I said, lower interest rates, the economy improving, and earnings coming back, and plus the pretty attractive valuations. So that's a country I think I'm positive on for the next couple of years. And as the next slide shows you, for example, I was mentioning growth is coming back. So they had 6 quarters of negative GDP growth until probably June of 2023. But in 3Q and 4Q of 2023, they had positive growth, with fourth quarter of last year showing about 4.5% GDP growth, so coming off a low base. So they can easily do about 3 to 4% GDP growth this year as well, with remittances and tourism doing well. Plus, they should have a pretty strong agricultural output this year. They've had very good rainfalls. That's positive for income levels because a large part of the population is involved in agriculture. Plus, it also helps inflation keep food costs under control. And as I mentioned previously, also on various calls, that the Port of Colombo is has a very good strategic location in the Indian Ocean, and very well leveraged to India's growth, because most of the shipments or container shipments that happen in the Port of Colombo are to India. But almost 80% of volumes handled at the Port of Colombo is for transshipment to India. And they are the busiest port in South Asia, which I don't think not many people know, but they handle the most containers in South Asia, and they're only increasing capacity over the next few years. So it could be a very important hub for the region, and that should also help the economy. And also one more point on Sri Lanka, for example, when China boomed in the 2000s, many of the Southeast Asian economies like Malaysia, Singapore, Indonesia, and Philippines, or even Vietnam and Thailand, they benefited a lot from China's growth in terms of tourism, trade, and investment. So I think Sri Lanka also can benefit from India's growth over the next decade. So I think they're very well leveraged to India's economy in terms of tourism, trade, investments, logistics. So I think Sri Lanka, besides just domestic reform and domestic growth, they're very well leveraged to the India growth story as well. So it's a very good play on India doing well also. So I think that's why Sri Lanka is a country that stands out in the region. Just following on the next slides is GDP growth, for example. I think this is for the first time in probably a couple of years, I've seen multilateral agencies like ADB and IMF now talk positively about GDP growth for the region and also for the global economy in a long time, ever since probably the war in Ukraine. Most of these banks have been downgrading growth, but now they've upgraded growth or talking more positively about growth going forward. So most of the countries, or most of the key countries in our universe, are expected to show 5% plus GDP growth, some showing even 6% GDP growth. For example, Bangladesh, Vietnam, Mongolia, all getting to 6% plus next year, and Central Asia being pretty stable at 5%, 5.5%. So again, strong growth across the board. So I think overall things are shaping up very nicely for our markets, with improving macroeconomic environments plus strong growth and overall stability. And as the next slide shows you, can you go to the next slide, please, Peter? Yeah, so next slide is basically, as I mentioned to you, one of the key factors driving the re-rating in our markets is the macro recovery and the earnings recovery, which is taking place across our markets. So besides just a macro recovery happening in Sri Lanka or Pakistan or Bangladesh or Vietnam, that should also drive earnings. So, for example, earnings should make a pretty strong comeback in 2024, especially second half of 2024, across our key markets like Bangladesh, Pakistan, Sri Lanka, and Vietnam. So, because most of these, I would say pretty much all these countries had a tough time in 2022 and 2023. So, I think earnings will come back, should come back pretty strongly this year and also 2025. For this in combination with lower interest rates and attractive valuation should be positive for the market. And just following on from this thesis or this theme on the next slide. So valuations are very attractive in our markets, as I was mentioning. So this is just a combination of the factors I've talked that I've spoken to you about. For example, monetary easing from central banks and universe, the macro earnings recovery, and this is basically supported by attractive valuation. So as Thomas mentioned in his introduction, the P ratio for a fund is basically at, pretty much an all-time low at 7 times. And one reason is because earnings have, though earnings have been, like I said, earnings have been weak in, for example, in Bangladesh or Vietnam or Sri Lanka, earnings in other parts of the universe have been very strong, like Georgia and Kazakhstan, where companies are growing earnings at still more than 20%. And that's, I would say, almost 15 or 16% of the portfolio. But besides that, even for example, in Vietnam or Sri Lanka, our bottom of stock selection has been good. So though the economy is not doing fantastically well, earnings have still been pretty strong. So for example, in Vietnam, most of our in fact, almost all our key holdings have shown very strong earnings growth because they're industry leaders in their various parts of the economy, like for example, logistics or banking or technology. And I'll talk a bit about those our top picks going forward, so you can get an idea as to why valuations have not really gone up despite strong performance. So, for example, as the next slide shows you, uh, uh, so I'll just talk about my top picks. So as the next slide shows you, for example, Halyk Bank is our second biggest stock position in the fund. It's the largest Kazakh commercial bank or largest bank by assets in Kazakhstan. As the chart on the top right shows you, it's done very well, up almost 50% over the past year. Still trades at a PE ratio of a little more than 3 times because earnings have been very strong and dividend yield of more than 12%. And it's not a small bank. So, for example, many investors or prospective investors say that frontier markets are smaller companies, but that's not really the case. For example, even Kazakhstan, the last year this bank's net profits were $1.5 billion, which is, I would say, equally more or is significantly more or in fact in line with many of the large banks in Southeast Asia. So by no stand from no angle are many companies in frontier markets very small. You have very large companies in frontier markets as well, especially in countries like Kazakhstan or Georgia or Vietnam or Bangladesh and Pakistan. And as the next slide shows you, this is our top pick in Vietnam, this is the biggest software outsourcing company in Vietnam. Its market cap is $5 billion. This is the largest. This is the fund's largest position in Vietnam. About 4% of the fund. It's growing earnings by 20%. It just declared its first quarter numbers a couple of days ago and grew net profits by 20%. And they're basically getting a lot of business from Japan, Southeast Asia, the US, and Europe, and doing extremely well. And just a few days ago, they signed a deal with NVIDIA to develop, do some kind of research or design on chips for data centers. And this company is also setting up quite a few data centers in Vietnam. So it's doing extremely well, very good management, and basically the stock has done extremely well for us. And this is a company to watch out for. It is my top pick in Vietnam. I think it should do much better going forward as well. And the third topic one of my third topics I'll talk about on the next slide is the Lucky Cement, which is in Pakistan. This is our biggest position in Pakistan, about 3% for the fund. And it's a company which is leveraged to Pakistan's economic growth. So besides being the largest and lowest cost cement producer, it also has exposure to other businesses. For example, it's got a JV with Kia Motors, which is doing very well in the auto business. It's got a JV with Samsung for assembling mobile phones. It's got an equity stake in ICI Pakistan, which is soda ash and other chemical products, and also got exposure to the power sector. And the P ratio is less than 7 times. So again, the stock actually is doubled for us in the last 1 year. It just shows you the strong re-rating that's taken place across our markets, and we've kind of leveraged on that with some good stock selection. And the last topic I'll talk about is the Commercial Bank of Ceylon in Sri Lanka. This is our biggest position for the fund in Sri Lanka. We've been actually accumulating this stock over the past few months because I think it's leveraged to Sri Lanka's economic recovery in terms of high loan growth, lower NPL ratios, so therefore, better profitability. And again, trades at, PE ratio of just less than 7 times and price to book of 0.6. So I see the ROEs on this bank improving going forward, which should be positive for the stock as well. So I just probably will wrap up with a bit of a snapshot and conclusion on the next slide. As I mentioned, the fundamentals for the fund and the fund portfolio holdings are extremely solid with the return on equity of close to 30%, strong earnings growth, through very good stock selection and, very discount valuations, attractive valuations. But overall, basically it's what so far this year has been a continuation of what has happened over the past 12 months. I was very positive on the re-rating for Asian frontier markets since the end of 2022. That's played out and this continues to play out. So I'm not surprised. All the factors that I spoke to you about, monetary policy easing, earnings and macro recovery, discount valuations, that's still in place. So I still think that'll play out, over the next 12 to 18 months. Many of our economies are coming out of a crisis, not going into a crisis. Even the global macro situation in terms of the Fed and, developed central banks is improving. So I think the Asian frontier markets are in a very good cycle for, sustained performance over the next couple, not just 2024, but over the next couple of years. And I think Sri Lanka is a country to watch out for, I would say, with a two to 3 year view. So yeah, I mean, if you invest in the Asia Frontier Fund, you made some good returns over the last 18 months. If you're not, and I think you're still pretty early in the cycle and you should get in touch with Peter for subscription forms. And with that, I'll hand it over to Ahmed, who will talk to you about the AFC Rug Fund. Thanks.
Thank you, Ruchir, and thank you all for taking place. Thank you very much all. Peter, can I have the next slide, please? Okay, I think all of you who've been watching the Middle East in the last few weeks will probably have realized that the worst nightmares of an increased real sort of war in the region almost became true. And yet, the Iraqi stock market, for giving an idea, as you all might be aware, it started really, I mean, like the escalation or the real potential conflict, I mean, spreading to a war started with the presumed or supposed attack on the Iranian consulate by Israel on the 1st of April, and then followed by the Iranian response on the, I believe, 14th of April, and then finally the supposed Israeli counterstrike in Iran on the 19th of April. And if you read all the newspapers and so forth, you will read the stuff that actually we've crossed the Rubicon, we've come to a new cycle of conflict in the East. Now, I'm not going to argue with any of those because I'll be looking at the financial element of that. At that time, by the way, those three events that happened, the Iraqi Stock Exchange is up 20.5% since the attack on Damascus. It's up 12% since the attack on Israel, and up another 5% since the Israeli response. And in a way, this is pretty much tells you exactly what we've been arguing, I think, ever since the conflict became a potential in October of last year, and then subsequently a few months ago, that the markets are discounting a very, very different picture to all of that. And as a market participant, I take more stock in what the market says to me than anything else. Now, if you look at the charts in here, basically, I'll give it to you sort of like three ways. If you look at the chart at the top right-hand corner of the screen, you'll see it's actually basically looking at the red line is the parallel exchange rate of the dinar versus the dollar, and the green line is the percentage difference that is above the official price. And you can see we had a peak, i.e. a peak in the US value or a bottom for the Iraqi dinar in early November. Between then and now, the Iraqi dinar has rallied something by about 12% versus the dollar, or the dollar declined by 12% versus the dinar. That's hardly a sign of a market of a country or a work that is actually being concerned about flight, capital risk or capital flight and so forth. The same way, you look at the Arabic Securities Index, which is an index that we follow, and it's actually our benchmark. You'll see, basically, again, I'm charting it here at the bottom right-hand corner, and that shows you a increase of something like 30% since the beginning of that conflict. So basically, the country is actually moving to a different tune and discounting the conflict very differently. Finally, I would say is you look at the left-hand corner, left-hand bottom chart, and that is oil prices. looking at it market expectation based on futures prices, and I've been tracking those closely for the last few years. And what you have here, basically, you'll have the green line is actually actual prices, and then you have the rest are expectations. So the clearest sort of sign that when we argue that things are looking positive for Iraq, we're at the end of 21. When, if you remember, we were recovering from COVID and we were beginning a new rebound and recovery and so forth. And that's where the gray line shows you where the expectation of future oil prices were. As far as I was concerned, then that is a positive environment for Iran, given its leverage to oil prices and given how every dollar change in oil prices, how that affects us directly. The red line was the line that shows you the extreme fears that happened after the invasion of Ukraine. Ever since then, by the way, they have been bound. Expectations have moved up and down depending on our expectations for global economy, demand from oil, or supply of oil have moved between those two elements. And even at the height of the fears on what Israel would do, so at the end of the Israeli attack, you look at the expectations and they are elevated, which is very positive for Iraq, but it's not outside that range. So end of the day, wherever they are, especially if they stay elevated, that increases the potential for the economic expansion that Iraq sees. Next slide, please, Peter. Now, the real reason why that is taking place and the real reason why the country or the economy is moving as such is actually the country's own dynamics. Yes, they're discounting the effects or fears of the conflict, but they're moving to their own dynamics. And these basically are what we've been arguing for quite some time, basically, and that is the changes brought forward by the Central Bank of Iraq on cross-border transfers. These were significant changes that actually have done, if anything they've done, they've speeded and they've accelerated the adoption of banking, which is one of the key tenets of our investment thesis in the country. By looking at the banking sector, the argument is as you have increased use of banking, as you have increased use of banking services, the country becomes more and more dependent on that, because give you an idea, as of a couple of years ago, the latest data available shows you that cash accounted for something like 85% of transactions. Now, as we move towards adoption of banking, the bankings will end by lending, by expanding the money supply, and therefore expanding economic growth significantly. So what the events did in terms of the changes across border, they merely accelerated. Central bank and the government took further measures over the year. And that only say that what that did, by the way, it created the massive economic incentives for informal companies, which is the bulk of our activities in Iraq and pretty much in the Middle East, by the way, to move to formality. And that has helped the banks, which disproportionately helped the larger or the best banks. And to give you a sense of the changes in those, you can see the figures here in terms of year-over-year growth in net profit and equity bank for the top 4 banks. And you see some incredible figures of the Bank of Baghdad, which is up over 190% in terms of earnings, while its book or equity increased by 35%. National Bank of Iraq up by 590% and up by 52%. Now, what my expectations is that this pace of economic of acceleration will bound to slow down. There's no way they can grow like this, because the events of the changes in the south, they've accelerated the move, but at some stage it slowed down. I expect it to slow down relatively sooner than later. But nevertheless, what will emerge when that stabilizes, you'll have a higher base from which those banks can grow, and a higher base from which, and a higher quality of earnings. Now, it's difficult right now to look at real estimates of what it will look like this year, because the changes are so massive. But I'd expect they would settle at the end of the year, or sort of like if we look forward, at around 20 to 25%, which is going to be a very healthy place for these banks to grow from, especially given where they are in terms of relative equity. Now, I end my piece. I apologize if I took a bit longer than I expected. For the month, I mean, as Thomas was arguing earlier, can't still see a reason why nobody looking at frontier emerging markets. I, on my part, can't see why anybody is still not looking at Iraq, in spite of the gains. Right now, for the month, the index is up 20.3 as of today's close, and 19% for the year, while the fund is estimated to be up something like 16% and 21% for the year. So, as Ruchir would say, as ended, I would argue the same thing. It is time to look at Iraq and call Peter and subscribe. But thank you very much for that. And with that, I passed on to my colleague Scott, who looks after our Uzbekistan fund. Thank you.
Good day, everyone. Next slide, please. So for those of you that have been following Uzbekistan for a while, and certainly for those of you that have come here, it's very obvious what's going on the ground is the country transitions and is growing quickly. And the demand side of things is certainly causing our portfolio companies to do well. Of course, over the last 2 years, performance hasn't been great, and that's due to really legislation, which I'll talk about a bit later. Diving into a bit of macro, last year the government had an election. There was a change in the constitution. There was also a bit of a government shakeup. So the government had their budget deficit to GDP reach 5.5%, which breached their 3% target. Earlier this year, they announced that they'll do some belt tightening with the aim to get back to 3% budget deficit to GDP by 26. So they've been spending a lot on social programs, and also due to, again, for those of you that have been here, the rampant demand in the economy for really utilities, among other things. They've rolled back a lot of subsidies, eliminated a lot of them completely, especially in the realm of food, so flour and whatnot, and cooking oil. But for gas, electricity, water, they're still there. And with demand rising, this is putting a huge burden on the budget. Specifically gas. By the end of this decade, there's discussion already that Uzbekistan might not export gas any longer. We're already importing from Russia along with oil. But just domestic consumption is booming for a variety of reasons, which I'll get into in the next slide. So nonetheless, with the belt tightening, you're seeing the economy slow down modestly. You're seeing a few more, definitely more for sale signs for real estate in the country, partially because Russians that came here when the war started are cycling out, but also the economy was a bit hot. So the World Bank has decreased their GDP forecast for this year to 5.3% from 5.5%, putting a bit of further strain on the economy. Again, the country's main exports, mainly being one of them being gas, is being rolled back for domestic consumption purposes. And then due to sort of the global quasi-manufacturing recession you saw over the past 12, 18 months, has put strain on the country's textile exports. Exports were estimated to be last year at about 3.3 billion. They were 3.1 billion, so a bit below expectations. And that's also due to, of course, competition from regional competitors, South Asian, Southeast Asian manufacturers, and the logistical challenges the country faces. Next slide, please. Nonetheless, again, the economy is continuing to move in the right direction, and the Chinese are coming in a very, very big way. I highlighted this in our last newsletter, and this is exciting because I saw it happen firsthand in Cambodia in 2015. There was an ASEAN summit, and due to some topics of discussion which were not discussed at the ASEAN summit, the Chinese rolled in with tens of billions of dollars. And it looks like they're in the process of doing the same thing as they expand the Silk Road initiative heavily into Central Asia, especially being that Kazakhstan and Uzbekistan specifically have been very hesitant to roll out the red carpet to the Chinese. But over the past 12 months, the Kazakhs have been doing it. Now the Uzbeks are doing it. So in January, there was a Uzbek delegation. My understanding is a few hundred Uzbek government officials went to China, and thereafter, you saw deal after deal after deal being signed. There's multiple deals with Chinese companies on a weekly basis being signed. So the FDI, I estimate, is roughly 10 to 15 billion announced just so far in the first 4 months of the year. So it'll be very interesting to see what happens throughout the rest of this year. BYD, Li Auto are two auto factories that are doing business here and looking to do JVs here. And then you have a whole host of Chinese groups involved in infrastructure, mining, pharma, petrochemicals. You're seeing Chinese restaurants open really all over Tashkent. There used to be, I think, about 3. Now I've seen well over 10. You've got a few Chinese hotels popping up. There's Chinese everywhere on the streets, both for tourism and business purposes. In my apartment block, where there's probably 200 apartments, there's easily 30, 40 Chinese. So something has changed here in a very big way. And when you look at sort of my new Fertile Crescent thesis of who's going to be doing business in Central Asia, the Chinese are a big player, and they're now coming in with money, and they're moving quickly. So this is going to cause presumably huge demand, especially as they invest in infrastructure, factories, et cetera, to take advantage of the population here, which last week, I believe, reached 37 million. When we came here in 2018, it was roughly 34 million, the population. So this is one of the few countries in the world where not only is the population increasing, but the rate at which the population is increasing is accelerating. So it's a great story for this country to be, again, as we've discussed and argued for, sort of the Vietnam of broader Central Asia. So no doubt this will cause rise in demand for materials, financial services, and in due course, consumer goods, which is what the AFC Uzbekistan Fund has exposure to. Next slide, please. So, as I've discussed time and again in our monthly updates over the past roughly 2 years, there's security capital markets legislation which is stuck in Parliament. It's moving forward, but at a snail's pace, and this is really what's holding up the next re-rating. We've gotten a handful of investors asking us, why is the fund not performing when the economy is doing well? And this is really the situation. We have a bit of a walled garden scenario where the infrastructure needs to be upgraded for the capital markets. It's in the process of being upgraded, but the new capital markets legislation needs to be passed. And the sandbox legislation I've talked about in the past is part of this. But this will allow for easier brokerage account openings. It'll get more international, it'll get international custodian banks to come here, the connection to Euroclear, Clearstream, etc. So we're waiting for this. Nonetheless, over the past few weeks, the government, along with the stock exchange and the regulator, have been pushing for developing a USD corporate bond market because, as I've discussed, and over the years, there's a huge cost of capital issue here. They're also discussing allowing for ETFs and REITs to trade on the exchange. And then as part of the sandbox legislation, the Bank of Georgia has agreed to be the initial custodial backbone of the infrastructure. The problem with this is that Bank of Georgia, it's great to have them here. I've mentioned before that I'm aware of Russian brokers that want to do business here. I'm now aware of 3 Russian brokers that want to do business here, and each of them very easily, if the infrastructure was in place, could allocate $10 to $15 million to the capital markets overnight. That's peanuts for these guys because we're talking about billions of dollars that they manage. The problem in my discussions recently is that they don't really want to do business if Bank of Georgia is the custodian because 1, there's historical issues with Georgia. 2, they're very worried about capital being frozen. So there's a wave of Russian money and regional money that wants to come here. It's just a matter of getting the infrastructure right. So, but on that note, is we have this walled garden scenario. When you look at the fund, the companies that we have exposure to are doing very well. So of the companies that have reported 2023 earnings so far, 2 of them are in our portfolio, and these 2 companies happen to be our top 5 holdings. The first one, which is financial services, has grown very well. This is the commodities exchange. Even with the robust growth since the country opened up, they're still doing well, and they still traded a 14.5% dividend yield. And then the cement company, which was the biggest cement company in the country, Kızılkum Cement, they reported very strong earnings. They traded a PE of 2.3 times, 0.3 times book, 0.36 times book. So they have 4.2 million tons of capacity. And we believe for probably the past 6 or 8 months that this company was going to make a move in due course and try and do a roll-up of the cement industry in Uzbekistan. And that's due to the fact that over the past 5 years, you've seen a handful of medium-scale cement plants between 500,000 tons and 1.5 million tons a year being built, either by Uzbeks, the Chinese. So Anhui Konch, I believe, has 2 factories that they're building here, and then some Turkish money as well, some Kazakh money. So you have a handful of small cement plants, which it looks like Kızılkum Cement is in the early stages of trying to do a roll-up. So there will be discussion at their AGM a bit later this year to potentially lease a cement plant with 1 million ton capacity per year. It's in the same city as the fund's second largest holding, which is Uzmet Kombinat, the steel company. So that could be really interesting as they try and build a quasi-monopoly in the space. Cement is a great business. It's certainly one of perpetual economies of scale, especially if you're competing against others. But if you have a large dominant position in the market, you can print money. So the companies are doing very well. They're very cheap. And again, when the infrastructure is in place, which I wish we had a timeline for, but nonetheless, when the infrastructure is in place, we expect a re-rating to occur similar to what we saw in 2020 and 2021 for the fund. It's really just a matter of patience. But in the meantime, the Uzbek economy is still doing very well. So with that, I'll pass it off to the CIO of our Vietnam fund, Vicente Nguyen.
Hello, everybody. Go to the next, please. Actually, everybody knows that in 2023, we had very poor performance in terms of GDP growth. Last year, we have only 5% GDP growth, is quite low compared to 2022, 8% 2022. However, because of the impact of the global economy, when US increased the interest rates in Europe, they have the war, and we also have our internal issues related to real estate crisis. So the government had issued a lot of supporting policies to boost the economy grow again. For example, one of the key policies, they cut the interest rate. So at the end of 2022, when the deposit rate were around 12%, right now the interest rate is only around 5%. It's really support the enterprise and the whole economy. Another policies they already did is they cutting rate, cutting tax, and they also pump billions US dollar in terms into infrastructure investment. So a lot of key projects in Vietnam are being built right now. For example, Long Thanh International Airport, or the North and South Highway to connect the Hanoi and Ho Chi Minh City is more than 1,100 kilometers. The reason why in the first quarter we have very impressive GDP growth is 5.66%. This is the highest in the last 5 years. Is even higher in the first quarter of 2022, when we had the GDP growth of 8%. So I am very confident that this year we will have a much higher GDP growth than 2023. According to our estimations, the GDP growth around 5.8 to 6% this year. Go to the next, please. One of the most important factor for the Vietnamese economy is the export. So exports is very important to the whole country with nearly 100% of GDP. So last year, when we have negative exports growth, the country's GDP growth tempo in this. So, however, since September, we saw the rebound of the exports. So since September, October, November, December, January, and February, and even March, the exports has very impressive growth in terms of exports. The reason why we strongly believe that this year we have a very positive growth in terms of exports. Therefore, we already allocated our fund roughly around 25% of the whole portfolio into the export sector in the third quarter of last year, in June and July, in July and August, most likely. So we are following very closely the exports number of the Vietnam. And according to the half month of April, export they have a positive growth month again. Go to the next, please. Another very interesting information about Vietnamese stock markets is the emerging market upgrade potential. According to FTSE, yes, Vietnam is quite far away from MSCI's upgrading. However, FTSE is less, how to say, they are more flexible, and the only one factor that to prevent Vietnam to be upgraded into emerging market is the pre-funding regulation. And right now, the government, the SSC, State Security Commission of Vietnam, is working very hard with all the broker, custodian bank to finalize the procedure for pre-funding regulation. And I think that within this year, probably in the second half of 2024, the regulation will be approved and can be applied. So the foreigner don't need to put their money before the buying stock any longer. And according to the estimation of JP Morgan, if Vietnam is upgraded into emerging market, the weighting of Vietnam in MSCI in emerging markets could be around 0.3%. It's still very limited and very humble compared to other ASEAN markets like Philippines, Malaysia, Indonesia, or Thailand. But anyway, it's a very important first step for the whole market. And they also estimate that the passive and active inflow into Vietnam, if Vietnam is upgraded into the emerging markets. So FTS, it could be around 0.7 billion US dollar, and other index provider can attract 1.4 billion dollar, and other active fund roughly around 4 to 6 billion dollar. So this could be a very important support for the whole economy, and even in general, and the stock market particularly. Go to the next, please. So right now, Vietnam stock market has a correction in April. So month to date, right now, the Vietnamese index dropped around 8%, 8.5% in US dollar term. There are some reason for this drop. The first reason is the Vietnamese dong devaluation. So this month, because of the strengthened US dollar all over the world, not only in Vietnam, but also in other emerging markets, the local currencies became much weaker against US dollar. And in Vietnam, Vietnamese dong also lost 2.5% in April. A reason why foreign investors is shown a lot of share on the stock market, and it's make a negative investment sentiment for the local individual investor. The reason why there's were a sell-off. Another thing is there's some rumor on the market. Yeah, nobody confirmed this kind of rumor. Even the government already confirmed that it's on fake. However, with typical markets like Vietnam, that local individual investor occupy roughly 80 to 85%, sometimes 90% of the daily trading volume. So they are completely impacted by the rumor, and they started a sell-off, and the market started to correct. However, in our point of view, is a healthy correction, because in the first quarter, according to our estimation, the earning of listed enterprise in the first quarter roughly up around more than 20% until now, is much better than expectation. And the GDP also supported for the stock market. The only thing is the psychology and the investment sentiment of the local individual investors. So I am absolutely sure this is the great time to enter the stock market right now. So thank you very much for listening.
Thanks everybody for your, as always, interesting and insightful presentations. We will now answer some of the many questions we have already received from the participants, but you can still submit more questions during this Q&A session through the Q&A button at the bottom of the Zoom screen. So the first question I have here is for Vicente. What is the possibility of the USA putting tariffs on made in Vietnam products, given Vietnam's positive relationship with China? For example, sourcing of material technology from China.
Yeah, as you know, that US always use the tariff like a negotiation tool or a weapon on the country all over the world. Actually, Vietnam just signed a deal with US last year in September when Joe Biden came to Vietnam to upgrade the relationship between two countries from comprehensive partnership to strategic comprehensive partnership. Actually, this deal is a great opportunity for Vietnam to export the product from Vietnam to US. So actually, I do not think the US will how to say, apply the high tariff on Vietnam just because of the relation with China, because China is our neighbor with the same border. We cannot live away from China. And Vietnam already benefit a lot in the last few years when the tension between US and China. And I think Vietnam's are quite good in terms of balancing the relation between China and US. So a reason why we are one of the rarest beneficiary all over the world among the global turbulence and the political tensions. So we do not have any tension with any country in terms of trade war or something like that. So yeah, nobody knows what will US will do, but according to the how to say the current situation, I do not see any reason why US should put a higher tariff on Vietnam after they signed a deal with Vietnam, and they did it. It doesn't make any sense. It did.
Yeah, okay. Thank you, Vicente. So next question is for Ahmed. Who are the main investors in the Iraqi stock market, if it's retail or institutional? And what is the foreign percentage ownership of them after, foreigners, obviously?
Well, most of the investors are retail, and they are mostly local retail markets. They are high net worth individuals who can be as big as institutions, but mostly are retail. Foreigners, foreign ownership, by the way, the figures are quite hard because basically you have a large number of the banks that are, let's say, something like, if I remember correctly, over 30% of market cap, as well as the two telecom companies, which together between them, they're talking over 80% of market cap. They're majority owned by foreign institutions. So you're looking at banks owned by other banks and so forth. So there's no data for separating those from that. But if you look at foreigners investing in the country, i.e. funds or individuals, that I would say is very tiny. Out of something like 5 or 6 funds that were there when we launched the fund in 2015, there's only 2. And looking at daily transactions in the market over the last few months, and actually even over the last few years, you look at foreign activities, which you'll see it in our presentation on the Iraq fund, it's mostly selling. So basically, it's surprising. I mean, one of the positive things is if the foreigners do change their mind and look at Iraq, there's going to be a huge upside. They did that in 2012, I think, when the market had a very strong period before then, and the market exploded. So net, there's very, very foreign investors. And I think that's one of the reasons why it's actually de-linked and makes an attractive market to look at. But also, it tells you the potential should we have, 1 or 2. And not any more, and the market can move substantially higher just by the weight of money. I think that should have answered. Thank you.
Okay, thank you, Ahmed. Scott, one for you. How is Uzbekistan impacted by the rising geopolitical tensions between the Western world one side and Russia and China on the other side?
Thanks, Thomas. I'd actually say it's a 3-way push and pull. It's the Western world, Russia, and China. Historically, Uzbekistan has been very tied to Russia because it's a former Soviet republic. At the end of the day, when it comes to influence, I don't think that's going to change. But if you look in the past 12 months, the deals that they've done with Russia for oil and gas and other deals, the opening the doors to China and allowing the Chinese to come in a big way, I think is a way to counterbalance Russian influence. Again, the Chinese are going to come in with money, but realistically, in terms of culturally and whatnot, and politically, it's going to be much closer tied to Russia. And then they have the West, which really the influence there comes from, say, some military training, and the majority of it would be from the international financial institutions, the EBRD, IFC, ADB, doing business here. So, for example, I believe last year, the year before, the EBRD based in Kazakhstan, their office there did more business in Uzbekistan than in Kazakhstan. So Uzbekistan reminds me very much of Cambodia with the Japanese, the Chinese, the Vietnamese, the Thais, and then Mongolia with their third neighbor policy because they're sandwiched between the two superpowers of Russia and China. Uzbekistan is going to play one side off against the other. In terms of geopolitical tensions, in Central Asia, there really aren't any strong geopolitical tensions. The West certainly wants to prevent Central Asia from falling too far into the orbit of China and Russia. The reality, of course, they're not going to be able to prevent it because just geographically, who is Central Asia going to do business with? Where's the soft power going to come from? It's going to come from the new Fertile Crescent region. But I expect it to, stay a very peaceful part of the world, but also receive a lot of investment as the Chinese try to gain influence, Russia tries to gain influence, and then the West tries to gain influence.
Okay, thank you, Scott. Now one for Ruchir. With such a good outlook for Sri Lanka, why is it still a relatively low exposure in the Asian Frontier Fund?
Yeah, thanks for the question. I mean, well, it's relative, right? So, for example, I mean, what I was saying in the presentation is one of the markets I'm positive on is Sri Lanka from a 3 to 5 year view. It's not the only market that I'm positive on. And also just to, follow up on that is, for example, at the beginning of the year, I was, if you go back to my previous comments, I'm positive on basically many of the South Asian frontier markets like Bangladesh, Pakistan, Sri Lanka. I think they can outperform this year compared to, say, some other markets. And broadly, I think many of these countries, even for example, Vietnam, are in a positive macro cycle. So overall, broadly, a positive for many of these economies. But Sri Lanka, I'm saying, is kind of standing out because it's been ignored. It's been in the news for negative reasons. But they're doing the right things in terms of reforms and in terms of they've seen a strong macroeconomic recovery. So I think it needs probably some more attention. Having said that, I think I'm not saying it's not like we've not increased our weight. So, for example, in March 2023, the weight to Sri Lanka was 3.8%, and now it's 6.5% now, so almost 7%. So the weight has increased quite, I would say, it's pretty decently compared to a year ago. But also, as we are more positive on some of the other economies, the weight has also increased to the other economies like Pakistan or Bangladesh or Vietnam. And also many of the other stocks in many of our economies have done well. For example, in Kazakhstan, Iraq, in Georgia, and Mongolia. So that also plays a role in the weights. So in absolute terms, we've increased the weight, and also in as a percent of AUM, we've increased the weight. So, and we could look to increase the weight going forward as well. So, I think I hope that answers the question.
Okay, I think we have time for one more question. It goes to Vicente. Vicente, what is your view on Vietnam's banking sector? Vicente, you're mute.
I'm sorry.
Yeah, no problem.
Okay. According to the current situation on the factor and on the ratio look quite attractive with the low PE, low PP, and the good growth. So banking sector is one of the most important sector of the index with 40% weighting, and it's also very important to the whole economy. So this is on the positive side. On the negative side, that the real estate crisis in 2022 is really impacted negatively to the bank. So, and after that, the state bank issue a regulation allow on a commercial bank to keep their bad debt at the same level, depends on their own assessment. So right now, actually, it's really hard to assess the bad debt level of the banking sector. We do not say it's high or low or moderate, but we cannot measure this number. So the bank has its own attractive size, but also has a risky side that we cannot count. So this is our point of view. Yeah.
Okay. Thank you, Vicente.
Yes.
This concludes our webinar today, and since we still had some unanswered questions, we will answer them directly by email to the person who asked it or wrote it. And if you have further questions, you can always reach us by email. I hope you enjoyed this webinar. We will continue to hold quarterly webinars in the future, and we will announce them in our upcoming monthly newsletters. So please read them. No, don't just press the delete button. Good night to our participants in Asia and to the others, and enjoy the rest of the day. Thank you.